Piper Sandler senior analyst Scott Siefers joins us now. Overall, Scott, how would you characterize the quarter for the banks?
Hey, Sarah, how are you doing? Thanks for having me. So, the bank earnings season's gotten off to a better than expected start with the biggest banks reporting. Some of the panicky fears to which you alluded a couple moments ago, they seem to have dissipated. I think investors are reflecting that in valuation. So, realistically, this strong start we've had from the biggest banks, that could lose some momentum as more regionals and smaller banks start to report. They might see more pronounced pressure on their deposit costs. But overall, a pretty good start to the season.
I mean, David was mentioning PNC and some of the regionals. Even the regionals appear to be in better shape than what was expected. So is there an opportunity here for these stocks?
To a degree, we've got historically low valuation. So I think today what you're seeing is probably some of the regionals. Even, you alluded to PNC, that had a little bit of a weaker than expected guidance, for instance. But I think it's still being pulled up by some of the stronger results you saw at maybe like a Bank of America, for example. And even there, they guided to perhaps a better than expected net interest income outlook for the remainder of the year. So I think that's sort of buoying some investors' hopes here for what the outlook will be like in coming periods. But you even mentioned it a couple moments ago. There's still plenty of wild cards out here. So from my standpoint, the question of sustainability of the recovery in bank shares, that's still a little bit of an open question in my mind.
You've got to sell on Bank of America, right?
Yeah, so we've got an underweight on it. I mean, it's a great company. It's done well over time. I think we tend to look at it in the vein of its peers, probably its closest one, J.P. Morgan, for instance. And, we just see better reward in J.P. Morgan, which is our favorite universal bank name. If you listen to Jamie Dimon's comments, J.P. Morgan really just blew NII out of the water a couple of days ago, which was great. But, he's quite candid about the likelihood that their net interest income will likely fall and is really overstated at this point. So whereas Bank of America is talking about, maybe a little more stability, that's great. And it's certainly helping the stock today. But, in our view, even if that's the case, for B of A, that probably means even better things for J.P. Morgan, just because the expectations are a little more rational there and would have more room to move up.
You alluded to the fact that you seem to be looking for more signs to get more positive. What would they be?
Yeah, do you mean on B of A or just generally? I think
generally, more generally.
Yeah, where I'll address that. So a couple of things. We've got both supply and demand issues in terms of loan growth, right? It's really at this point only credit card, which is just sort of a scale business. You've got J.P. Morgan, B of A, to a degree Citigroup, but most regional banks don't have that tailwind. So there's really a diminishing share of the pie that's driving most of the growth there. Additionally, we've got a lot of open-ended questions on where capital and liquidity requirements are going to go. So we need to resolve some of those. And then there's, of course, sort of the ... of eventually we'll have a credit cycle. David, you mentioned commercial real estate, and I'm afraid you were exactly right in your conclusion. We could be talking about that for up to a couple of years, unfortunately. It's just not going to have sort of an aha moment where we can sound the all clear that everything's okay. So just a lot of unanswered questions here that we'd like to get some better clarity on.